So, did you ever make a mistake while investing? I would guess if you answered no to that question, you either haven't been investing long enough or you're just not being honest with yourself because all of us make mistakes. And part of the part of this channel, part of what I want to create in this channel is transparency. So today I wanted to walk through what I believe is a mistake that I made in my portfolio. So this should be a pretty fun and interesting discussion. I think you'll get a lot out of it. I got a lot out of it. So let's get started. Hey guys, Kevin Burgess back again with another video. And today I wanted to do things a little bit differently. I want to talk to you about a mistake that I believe that I made in a particular stock in my portfolio. And I've heard this adage in my career where it says something like this: your mistakes don't define you. What defines you is how you handle them. So I thought today it would be interesting to talk about one of the mistakes that I believe I made, why I believe I made that mistake, and what I learned from it and what I'm doing to fix it. So those are the things that really matter when we make a mistake. One of the things in investing is that it is complex. There is a lot going on. There are tons of companies out there and life happens. And so we get busy and maybe we don't do enough due diligence, or something just comes right out of the blue and impacts our portfolio in a way that we didn't imagine. So for those of you who don't know me, my name's Kevin Burgess. I spent my career in the accounting, internal audit, and risk functions of an SEC reporting public company. So I think I bring a unique perspective on dividend growth investing. That's the style of investing that I've chosen to follow. If you like dividend stocks, or if you want to talk about dividend stocks, you want to learn more about dividend stocks, consider subscribing to the channel. I'd love to have you along for the journey. Guys, we've been struggling with internet here at my house. As you know, we've moved to a homestead in rural Alabama, and we've had a storm come through, and it basically tree fell and knocked our power lines down, and with that also went the internet lines. And so the power lines actually got restored relatively quickly. It was later that night, so they were out maybe 6 hours or so, but the internet took about a week to get reinstated. So I'm happy it's back, but I do have a lot of videos that are getting backed up. So I've got this video I'm going to do today. I've got another video on a stock. I need to give you a portfolio update. So I got a lot of videos that I need to do. I'm super stoked that the internet is back. And so don't be surprised if you see some sequential videos from me. I'll just be really getting caught up. So without further ado, let me talk about the mistake that I made. It was just a few weeks ago, I decided to invest in a company called UGI Corporation. I'll talk a little bit about UGI just so you know who they are if you're not familiar with them, and then I want to get into some of the meat of this discussion. If you look at some of the history, they became a public utility holding company in 1882. Man, that was forever ago. They basically have, and according to Simply Safe Dividends, they have three businesses. We'll talk about that a little bit more here in a few minutes, but they have this business around natural gas, especially up around Pennsylvania, West Virginia. So that's one segment. They also have a segment of what I would call midstream assets for the natural gas business. And then they have a liquid propane gas business. Now that business is international. It's not only in the US with AmeriGas, but it's also in 17 other companies, mainly in Europe. So let's take a look at some of their metrics. You can see that their dividend safety score is 90, which is pretty good. And what kind of attracted me to them is the 6.29% yield. So you can see in the last 5 years, they've got a dividend growth CAGR, which is a compound annual growth rate of 8% per year, which is fast. You can see that they've raised their dividend for quite a long time. They've got a dividend growth streak of 35 years and an uninterrupted dividend streak of 138 years. So all of that was looking really good to me. I looked at things like their earnings payout ratio, and that looked really good. It was below 60, and according to Simply Safe Dividends, they say 75%. But I think they're counting them as a utility, and I think that's the mistake that I made. Is they're only partially a utility. Earnings per share has roughly been up to the right, and then they showed the next 6 months as $3.36. But don't get too excited about that. We'll talk about that in a few minutes as well. The return on invested capital has been pretty good. In the last couple of years, it's been in the double digit arena. This past year, the last 12 months, however, is minus 4%. I thought, that's a blip. I will, not worry too much about that. And their net debt to capital, 61%, which is not too bad, but their interest coverage ratio is pretty low. So, on the surface, it looked good. And so from my perspective, when I find a company that I kind of like, and there's something about it that I really like, then I go ahead and I start a position, and it causes me to research further. That's what I did with UGI. I went a little further than normal. I went up to about 1% of the portfolio and invested in UGI. May have been 1.3% or something like that. Not terribly high, but it was a little higher than I normally just start a position in. And then I decided to do a little more due diligence. And it's that due diligence that I want to share with you today. And I think you're going to learn a lot from this. I know I did, and it was really impactful to put this on PowerPoint slides. So I'm going to share these slides with you. Okay, little analysis on UGI Corporation. So this is my analysis on UGI Corporation. The first point I'd like to make is that UGI has a complex business model. And if you take a look at the lines of business, they really have two lines of business. That's not too overly complicated, but they have a natural gas business and a global LPG business. That's liquid propane gas business. The utility business here on the left is a regulated business. It is the second largest regulated gas utility in Pennsylvania. And also in that arena are these midstream and marketing services here. It's the midstream assets are the assets that it takes to get the natural gas from the ground to where it's going to be distributed. So these midstream assets, they have a contractual component to them. So I like to think of this natural gas business as regulated from the utility perspective and regulated like in the midstream business, because the contracts tend to create this regulatory feel to them. So they got some pretty stable earnings around this 36% and this 23%. So that's roughly about half their business. However, when we get over on the global LPG side, they have an unregulated business, or what I would call a competitive business, which creates a lot of complexity because the skill sets that it takes to run a regulated business are not the same skill sets it takes to run a competitive business, and vice versa. So UGI has this business model that in my mind is very complex. You've got the competitive business, which needs to focus on marketing, cost, distribution, all of those things, and it needs to be profitable in an unregulated market. Whereas a regulated business has a cost structure that gets approved through a regulatory body, and they manage to that cost structure. So it's a totally different business model and therefore complex. And so that's point number one, is that what I missed in UGI's business model is its innate complexity. So the next thing I would share is that UGI has a complex geographic footprint. You can see here that they have 17 countries that they do business with in this European region. And, I don't know about you, but dealing with 17 countries, and there's no telling how many cultures are within each of those countries, and at least 17 governments. So it makes it really complex in dealing with the commodity business that they're selling, which is that liquid propane gas. So the third miss that I had was that not recognizing that their operating expenses were rising faster than their margins. And if we look at, let's say, AmeriGas propane, you can see that the margins are up 36 million, while the costs, just the operating costs, are up 32 million. There's still a bit of a margin there, but it's not enough. You can see they were losing money in the third quarter of 22, and they're losing less money, but they're still losing money in the third quarter of fiscal year 23. Now let's move on then to UGI International. This is more of those 17 countries that we talked about earlier. You can see that their margins increased by about $1 million, but look at their operating expense. It increased by $14 million. It was offset by some other activity, but this is really what's important from the business perspective: is what's the margin and what's the operating expense, and that's getting to be a pretty ugly picture there for UGI International. Midstream marketing, you would think that this would be pretty consistent, and it is, but the the margins went down $2 million. Operating expenses also impacted negatively by $2 million. So that's going in the wrong direction. Utilities, these should be pretty standard, pretty steady Eddie financials. They had margins that went up 5 million, but yet their costs went up 8 million. So at the end of the day, their margins are being pressured by all of these operating expenses. Now let's move on. The earnings, their earnings are falling short of their long-term commitments. They have committed, as you can see here on the screen, to a 6 to 10% earnings per share growth, with a dividend growth of 4% every year. The earnings guidance for fiscal year 23 is 275 to 290. Now, the midpoint of this is somewhere around this $2.82 range. So as I look at this, I look at the last 3 years, and I don't see 6 to 10% earnings per share growth. Now, they are growing the dividend by 4%, I think we saw earlier. But how long can they do that if they're not producing higher earnings? Let me just kind of wrap up what I learned about UGI. First of all, they have a complex business model. It is difficult for management teams to operate well in both a regulated and an unregulated business environment. Number two, they have a complex geographic footprint. Thirdly, costs are rising faster than their margins. And, this is happening a lot now because, we have inflation and costs are going up, supply chain costs are going up. And so we're used to that. But what we're also used to are the management teams getting, out in front of that and saying, here is what we're doing to reduce costs. Here's the progress we've made. I don't see that at all from UGI. As a matter of fact, I don't really get a sense of urgency from them about these costs. Their materials for the third quarter said, hey, we're committed to looking into it. They haven't really committed to any cost reductions. All they've committed to do is look into it. So that causes me a little bit of concern. And lastly, they're falling short of their financial commitments to the investing community. So from my perspective, unless they get some help from the market prices related to this LPG product, and remember that's an unregulated market, then they're going to struggle to improve their margins. Now, I'll also give you some caveats. And again, this is not investment advice. This is just me giving you my thoughts. At the end of the day, we all make decisions around our portfolios. And so my goal here is not to tell you what you should buy or shouldn't buy, but to just tell you what I'm thinking. And then, maybe you think the same way, maybe you don't, but that's all good. I just want to share with you what my thoughts are. I do have some caveats, though, I'd like to share with you. One is that UGI can be attractive at the right price, but what price? So at some point, UGI will get to a level where it's worth the gamble. And the reason I call it a gamble is because we're really counting on this LPG market to come back and provide some margin relief for this company. And that's how we're going to get some appreciable growth in this company, is through the LPG market. And so another way to say that is that we're going to hope that the market returns and that the market goes up. And from my perspective, hope is not a strategy. So from my perspective, in my portfolio, I already have two companies, that Stanley Black and Decker and Whirlpool, that I believe need a long-term window to recover. I believe they're going to recover, but it's going to take a long time to get there. And I think UGI has a chance to recover as well, but it's going to take a while. And I just don't. I already have two companies that I'm doing that with. I don't need another one, and so because of that, I've decided to exit UGI. It was probably one of the shortest relationships I've ever had with a stock. And just a shout out to my buddy, ex Dividend Dad from the Discord. He gave me a good analogy the other day. I thought I'd share it with you, and it has to do with relationships and stocks. Stocks are kind of like relationships that we have. You've got these ex girlfriends and ex boyfriends, and so you've built relationships with them, and you kind of enjoyed them being around at first, and then after a while you get used to them being around, and so you don't really want them not to be around. But sometimes those relationships get toxic, and we're a little slow in dealing with toxic relationships. So in the case of UGI, I decided that toxic relationship had to end, and it had to end quickly. So I just removed myself from it. And I don't know if it's a great analogy, but it really struck a chord with me. So I thought I'd share it with you in case that was helpful. So I made some mistakes with UGI. Again, it's not the mistake that defines me, but what am I going to do about it? First of all, I've gone through and I've learned what I missed, and I'm going to apply that then to my future due diligence. That's important. It's important that we learn from our mistakes and that we correct them. And so in this case, I've corrected it by getting out of that stock. And thirdly, to move on and get on with life. And so that's where I'm going to go from here. If you're a UGI investor and you believe in the future of the company, that's awesome, and I support you in that. But for me, it's not the right stock for my portfolio at this time. So those are my thoughts on UGI. And I'm looking forward to sharing my thoughts on another stock, a new stock to my portfolio, on the next video. If you're interested in seeing that, subscribe to the channel, mark the bell, and it'll let you know when I put a new video out there. So until then, I will see you on the next video.